All right, listen up. The tape is stopped, the desks are closed, and the week is officially in the books. So settle down, grab your coffee, and get your head in the game. I'm Steve, and this is your end-of-day briefing on the ledger. We don't deal in rumors here, all right? We deal in the brutal reality of the price action. Look, you're staring at a market that is deeply conflicted right now. If you want to survive the open on Sunday night, you need to understand exactly what the big money just did. We're talking about an aggressive equity squeeze, a total energy washout, a brand new institutional hawk running the Fed, and a massive geopolitical powder keg sitting right on top of it all. Pay attention, take notes, let's get into it.
Now, for those of you staring at your P&L right now, you saw the stark contrast in the action today. The afternoon block, well, it belonged entirely to the bulls. I mean, it was a relentless, aggressive push. Equity futures spent the final hours pressing directly against all-time highs. But hey, don't mistake that for pure economic optimism. That equity rip, it really only happened because the energy premium completely deflated right out from underneath it. It was a massive seesaw. Energy dumped, equities pumped.
So let's run down the closing tape numbers aggressively so you know your exact baseline heading into this weekend. S&P 500 futures, the E-mini, closed up hard, settling at 7,491.75. Brent crude got flush lower, bleeding out to $103.16 a barrel. Gold pretty much flatlined, holding steady at 45.14, and Bitcoin established a consolidated weekend floor at 77,150. Print those levels in your head, guys. That is the exact battlefield geometry we are leaving on the table tonight.
The S&P 500 futures contract made a serious statement today. The E-mini squeezed the shorts all the way into the closing bell. Now we are staring right down the barrel of that major 75.40 resistance peak. The buying pressure was just methodical. It was shaking out weak hands and forcing short covering all afternoon. You really don't see that kind of aggressive positioning into a Friday close unless institutional money is feeling very, very confident about clearing that overhead supply.
But again, here is the absolute fuel for that equity rep. It was a total, unmitigated washout in the energy pits. Brent crude broke down, settling at $103.16 a barrel. And why? Because the algorithms desks took control and aggressively priced in immediate diplomatic progress in the Middle East. The machines are betting heavily that peace is imminent. They're pulling the risk premium right out of the barrel and feeding that liquidity straight into the S&P.
All right, wipe the equity optimism off your faces for a second because we have a pretty grim structural reality to deal with. This afternoon's push happened right against a massive, seismic shift at the central bank. As of 4:15 p.m. Eastern, the Federal Reserve confirmed that Kevin Warsh has officially taken the oath of office as chairman of the Board of Governors. The Warsh regime is official. The street no longer answers to a dovish committee, folks. It answers to a known institutional hawk.
And trust me, the bond market knows it. Despite all the equity cheering, the 10-year Treasury yield is staring us right in the face at 4.57%. It refused to budge into the close. That is a massive structural cost of capital. You junior traders need to understand something right now. Tech multiples cannot defy gravity forever. Eventually, they're going to have to reckon with a risk-free rate sitting this high.
Let me hammer this home. Why is the yield stuck up there? Well, because wholesale inflation is anchored at a brutal 6%. And if you look at the long-run inflation expectations, they are actually ticking back up to 3.9%. You run those numbers, and it tells you one absolute truth. Chairman Warsh has zero room to ease. The pivot is dead. We are in a higher-for-longer regime, and the cost of doing business just got permanently more expensive.
So, that brings us to the geopolitical side of the ledger. The market dropping crude to 103 is basically pricing in a clean, neat ceasefire. But let me tell you, out in the real world, the physical friction points remain insanely volatile. We have two massive pressure points grinding against each other right now, and honestly, either one could completely detonate the tape on Sunday night. On one hand, you have Tehran's newly minted Strait Authority attempting to act like a toll gate, enforcing these arbitrary transit fees. Commercial desks are telling us Western tanker volume through the Strait of Hormuz remains down more than 90% below normal baselines. But look at the brutal reality of their leverage. Inside Iran, their war-damaged domestic power grid is facing a massive 25,000 megawatt structural shortfall. They're dealing with severe rolling blackouts. So it's a high-stakes standoff between a choked international waterway and a completely crippled domestic grid.
And here is the hard-hitting reality you absolutely need to bake into your risk models. The administration's tactical hold on kinetic airstrikes is entirely conditional on a complete reopening of that waterway. If negotiations stall out this weekend, the mandate to target Iran's remaining civil infrastructure goes live immediately. The missiles are quite literally waiting for the diplomatic outcome.
So, what does this all mean? We have a pure, binary weekend ahead of us. Let's weigh these outcomes directly against each other.
The bullish view. A finalized treaty is signed, officially ending the energy crisis. Brent crude drops back down to the $80 range, and the S&P 500 launches well past 7,600. Then there's the bearish view. Nuclear and shipping talks stall out. With global inventories already down 1 billion barrels, any breakdown sends crude straight to $150 and triggers an immediate, violent equity liquidation. It's basically a coin flip, guys, but with massive leverage.
The broader CRB commodity index, which tracks a vital basket of global raw materials from energy to agriculture, shows exactly how coiled the raw materials complex really is right now. We're talking about a global supply chain where physical inventories are already drawn down by 1 billion barrels. Think about that. The physical cushion is completely gone. If the algorithm's bet on peace is wrong, the rubber band effect across these core commodities is going to absolutely rip the face off anyone caught shorting raw materials.
All right, enough theory. Let's talk execution. Shift into command mode for a second. I am demanding clean execution from this desk come Sunday night. I absolutely forbid any of you from blindly chasing the weekend gap. The amateurs out there will be panicking and pressing market orders the second the bell rings at 6 p.m. Sunday. You will not. You're going to wait, you're going to watch the levels, and you are going to execute the plan.
Here are your tactical rules. First, watch 7,450 on the ES. We closed well above it, making 7,450 your absolute crucial defensive floor. If it breaks, the bulls are dead. Second, watch $107 on Brent. Crude is tightly coiled right now, and if it catches a weekend bid and rips back over 107, this whole equity breakout is a confirmed bull trap. Finally, take a cue from the biggest desks on the street and preserve your capital. They are holding massive cash reserves for a reason. Earning a guaranteed risk-free return on short-term paper is literally the smartest trade on the board until this macro architecture actually stabilizes. Always follow the big money.
Write this down and tape it right to your monitors. Small sizes, tight stops, stay disciplined. Watch your averages, manage your risk, and whatever you do, don't try to be a hero in a binary market. The real question is, come Sunday night, are you going to be the amateur providing liquidity or the professional waiting to strike? Have a serious weekend. This is Steve. The ledger is closed.